Hi there, eToro. It is Monday, and that means it's time to take a look at what happened in the markets last week. Let's jump in. Blood everywhere, I think summarizes it pretty well. If we look at just some of the ETFs and indexes that I tend to track, Chinese internet stocks down 33% on the year, semiconductors down 27% on the year, the Nasdaq Composite, the NSDQ100 down 24% for the year. By year, I mean year to date, by the way, so that's from the beginning of January until today. Lithium stocks not having a great year. Long-term bonds, it's been brutal on bonds, and I'll come back to that in a moment. S&P 500 down 15.5%, and this is an index that is pretty diversified, right? It's got 500 companies and lots of different types of companies of varying sizes. I know most of them are very large, but that too is now down over 15% for the year. So it's tough going. Now, part of the reason for this, besides all the obvious reasons that I talk about over and over again every week, is that the dollar has become incredibly strong. And there are a few different reasons for the dollar becoming strong. It's a safe haven, first of all, but also in an environment with rising interest rates, money tends to favor the dollar. So this is the dollar index, and you can see it's been moving northwards even today. This is a monthly chart, by the way, so each candle is a month. It hasn't seen these levels since January 2003, and a large number of the world's most important assets are priced in dollars. So US debt, which lots of countries and companies buy, priced in dollars. Gold, priced in dollars. Oil, priced in dollars. The world's largest company stock on the stock exchanges, priced in dollars. So this can have an enormous effect on short-term investors thinking about the value of those things. So for example, if the price of gold is $2,000 today, but the dollar becomes stronger and you are using a different currency within whatever country you live in, that means that the price of $2,000 has become more expensive to you because you need to convert your money to dollars to buy the gold. So all of those things, relatively speaking, become more expensive. It also means that any imports or exports from the US, imports that you get from the US, become more expensive, and so that part of the US economy starts to suffer a little bit. Right, last week I spoke about my portfolio, which has also been absolutely hammered through this year, but I wanted to speak about last month. So last month was the worst month for the Nasdaq Composite since the great financial crisis. A pretty heavy month for the S&P 500 too, and the Dow Jones Industrial, which had the worst month since the crash in March 2020. Now, pullbacks in the market, they happen every now and again, but very large pullbacks like we're seeing right now are far more rare. It absolutely sucks to see your portfolio of stocks being hammered like they are right now, but also it's a little bit exciting to me that we're seeing the size of a pullback, because eventually the market will turn, and the bigger the pullback, typically the larger the bull market on the other side. I don't think we are very close to an all-out bull market just yet. It takes a while for the market to rebuild confidence after the kind of pullback that we've seen, but I am pretty excited for what's going to come further down the road. In terms of bonds, it has been the worst bond market since 1842, since the 1800s. That is insane. Now, the bond market is quite an important market. I know that most people will probably be more familiar with stocks, but the bond market is much larger than the total stock market, by the way. Bonds are effectively debt, so you can take a loan from various different parties as a company or as a government in order to achieve whatever goal that you want to achieve. And the interest rates on these loans are determined by, well, let's exclude companies from the picture. If you're a government, they're determined by the economic outlook for your country, and also the interest rates set by the central bank. It depends on the duration of the debt that you're looking to acquire, but that's the fast and loose summary. So the bond market has been rising in terms of yields as investors' expectations for rising interest rates have increased through the year. And this jumped on the back of the war in the Ukraine because that drove inflation higher, and then everyone expected interest rates to be increased higher and faster than pre-Ukraine war. And there's an inverse relationship between the price of a bond and its yield. So the yield you can think of as the interest rate on that loan, and all bonds have an amount that the loan is for, but I'm not going to go into too much detail about that right now. What's very interesting about this, and let me zoom in a bit, is this is how special the situation is that we're in right now. The US bond market has had positive returns before inflation in all but 4 years since 1976. So even in 1994, when the Fed raised interest rates 6 times for a total of 2.5 percentage points, bonds lost only 3% in aggregate. However, this year, from January until now, bonds have lost 10%. The long and short of it is, almost never has the US bond market lost as much as it has in the first 4 months of 2022. I have a feeling that this is going to change through the rest of the year. I don't know if the change will happen tomorrow, next week, next month, but I'm pretty sure that for a decent portion of this year, we will see yields reverse and prices rise once again. And so for those that watch, you will have seen me dip my toe in TLT. So those are the longer term bonds from the US government. Another thing that we saw last week, so a lot of the selling that we saw last week was based on the Fed hike in rates. We saw a rally in stocks initially, but then the next day those stocks sold off again. The Fed they weren't dovish, they were just slightly less hawkish than they had been before. So the rate of quantitative tightening will be a little slower than the market had expected, and the size of future hikes probably won't be as big as some analysts had expected. But since that one-day rally, the markets have been heading in one direction, and that is down. What we also saw last week was the Bank of England raising rates too. So the US and UK are now sitting on a central bank rate of 1%. And although the UK doesn't get as much attention, the UK has been raising its rates for longer than the US. So I think they've been a bit more effective in addressing the issue of inflation, although our inflation rate is pretty high too. But they've also been quite honest at acknowledging the realities. So the Bank of England came out and said that they expect growth for the rest of this year through the UK, but that there's a decent chance that there will be a contraction in the UK economy through 2023. Now, in light of this piece of information, the fact that they've owned up to it, it looks as though even though rates are likely to continue to rise through the rest of the year, that they probably won't rise as aggressively as they have in the past few months. One of my favorite analysts out there is a lady called Lynn Alden, very clever lady from an engineering background that got involved in the world of finance at a very young age. She's got a very good understanding across the breadth of the macroeconomic picture, and she's very good at writing. And her opinion is quite succinct on this particular topic, and I think it's an opinion that's shared by a number of analysts out there at the moment. So the Fed can and will continue to tighten for a while, and they usually tighten until something looks like it's going to break or it starts breaking. So I think the last time we saw this was through the years of 2017, 18, and 19, where we were in a tightening cycle and the Fed had to start dialing it back when things started breaking. So the US didn't go into recession, but the Fed did reverse gears, hoping to avoid a recession that they had begun to create. So the highlight paragraph here basically says that the Fed can still hike for a while, and they will continue to do that. But when they start hiking to the levels of 3, 4, 5%, beyond 3%, let's say, the amount of debt that the US has taken on as a government, but also companies have taken on, individuals have taken on, mean that at those rates, things begin to break in a way that would be very difficult to fix. There's a debt spiral that could be created where individuals start defaulting, companies start defaulting, and then ultimately leads to a large part of the financial system being threatened. So the big question right now, the question that everyone is juggling is the Fed going to be able to achieve a soft landing? So are they going to be able to raise interest rates, bring down inflation, and still not force the US into a recession, or maybe the country dips slightly into recession? Or is a recession just unavoidable at this point in time? And nobody knows, right? So there are a number of very clever economists in the world, and the strange thing about them is that none of them are in the list of wealthiest people in the world. So they're very, very clever, but predicting the future is notoriously very difficult, no matter how much of an expert you are, no matter how much data you have at hand, no matter the size of your teams. It's just, there's too many moving parts. So we don't know which way this is going to go right now. We just deal with the probabilities. I forgot I wanted to show this, but this is just the tightening cycle that we saw from 2016 to about 2019. So you can see the Fed tightened through this period. Things started looking a little hairy towards the end of 2018. I don't know how many of you were in the market, but it was a difficult year. In 2018, they stopped hiking and then started to reverse the process through 2019. By the way, I think that even without a pandemic in 2020, we were probably headed for a pretty large slowdown in economic growth, maybe even a recession. Now, what's quite interesting is there's still some data out there signaling that there's growth in the system. And of course, the stock market is forward-looking, the bond market is forward-looking. But right now, at this moment in time, the system is still okay. I mean, the stock market, the prices in the stock market won't make you feel like everything's okay, obviously. But what you can see on screen are the loans and leases and bank credit across all commercial banks in the US. And you can see during the crash of 2020, there was a huge amount of stimulus that kicked off. And so the number of loans in the system increased. And then over time, these wore off, the growth wore off as things normalized once again, and they've been taken off once again. Now, historically speaking, while banks are still willing to lend money, you do still see growth within an economy and within businesses, and therefore usually within the companies that stocks represent, even if the stocks are tending downwards at the moment. So this is a decent sign of where we are right now. We can also see, I try to keep an eye on this, and reading the stats about earnings beats within any earnings season is a little bit tricky because there's some collaboration between analysts and companies to make sure that the numbers given by analysts aren't too far off. But what we can see here is that the percentage of S&P 500 companies beating EPS estimates is above the 5-year average for this earnings season, but the size of those beats tend to be below the 5-year average. And this is something that I've noticed anecdotally within the companies that I follow. Valuations don't matter right now, the same way that they did not matter when the market was running up through 2020 and part of 2021. But now, obviously, the direction that the prices are taking is down instead of up. So companies, there are lots of companies that are very strong. The market just doesn't care, right? So they're just throwing the baby out with the bathwater, and things are selling off. Now, I myself get a bit annoyed at the number of Buffett quotes that fly around the financial social sphere, but this one's from the last annual meeting, so I thought, it might be okay. I encourage you to read through the entire transcript of those meetings. It's got some pretty interesting stuff in there. So in reply to a question, Buffett said, "We haven't the faintest idea what the stock market was going to do when it opens on Monday." He said him and Charlie have never made an investment decision based on a guess about what the market or economy might do. We don't know. So just to continue, Buffett admitted, "We have not been good at timing. On the other hand," he asserted, "we've been reasonably good at figuring out when we are getting enough for our money." And this is the long and short of my investment strategy. It's very painful to see my portfolio, my stocks down by as much as they are at the moment. But if you buy a company that is cheap right now, even if it continues to fall, there's a very good chance that you'll see a decent return on your money when things turn around again. And they always turn around. I just want to pull out a few stocks just to show how crazy the market is right now. So again, you can't use the PE ratio for everything. I'm just using this as a proxy for expensiveness, and you can't use it on its own, but it does kind of a job in this case. So I've got Google in blue, Alphabet, and Amazon as the dashed orange line. Both of these companies have massively increased their revenues over the past few years. They've diversified their product set, increased their total addressable market, but their share prices have dropped quite a lot. Google's dropped quite a lot. I think Amazon's dropped even more through this year. Amazon I still think is a fantastic stock, and I think that's a controversial statement, but I'll put that to one side for now. What you can see here is that going back through the past more than 10 years is that Amazon's current PE ratio, I'm not sure 79 is right, I think it's more around 40s or 50s, but anyway, is the lowest that it has been for a very, very long time. At some periods it was zero because there was no profit. But when it wasn't zero, Google, we've got much of the same picture, right? So there are a few periods where the PE ratio has been lower, but for the large part over the past 10 years or so, Google's PE ratio has been higher than it is right now. That doesn't mean it can't drop off more, but it means that if you bought it now, but what it does potentially mean is that even if you buy it now and it does go down more, you've got it at a decent price. Once again, you can't price stocks purely off the PE ratio, but this is just a proxy for the point I'm trying to make. Another company that I'd like to quickly touch on is Makata Libre. So this is a company that operates in South America, so outside of the US and Europe, so removed from the challenges that we're seeing in Europe at the moment. Last earnings report for, I don't know if any of you read it, it was incredible. Their revenue growth, once again, was enormous. The fintech part of their business is growing like crazy. This is a company that's kind of like Alibaba when it still had AntPay as a part of the business, and AntPay was still growing and acquiring market share. It's still very early days for Makata Libre, but the stock price is getting pummeled. This is all the more ridiculous because this is a company that has more than doubled its revenue since 2020, quadrupled it since 3 years ago. It has this negative profit period where it was heavily investing in its capex. Also, there were problems in the South American economy, and now those investments are starting to pay off, and the forecasts for earnings growth are incredible. This is a company that, in my opinion, at these prices is a screaming buy. Digital Turbine is another company. Look, it's down 12% on the day, but it's grown its revenue 285% year on year. EBITDA growth year on year 184%. Now, they did acquire other companies, but they've integrated them successfully into their business, increased the size of their total addressable market, are already reaping value from these acquisitions, and the forecasts for revenue and EBITDA growth are fantastic. They've got an enormous moat. This is a stock that's getting absolutely battered. So coming back to this point, I feel your pain. Your pain is my pain. I guarantee to you that I am not immune to the movements in the market, but experience through decades of investment have shown me that a fantastic strategy is to find companies that are strong, fantastic businesses that are going to grow for many years to come, and that these companies are cheap. All right, that's it for this week. The best piece of advice I can give you if the movement in stock prices and other asset prices is getting you down is just don't look at them for a while. If you're a long-term investor, you don't need to look at your portfolio every few minutes, hours, days, or even weeks. Remember, you've done your homework, you found good companies, you've bought those companies at good prices, and now all you have to do is hang on. All right, speak to you soon. Goodbye.